لا تنسوا الاعجاب بالفيديو والاشتراك في القناة.
Welcome to part 7 of our seminar, Understanding Financial Statements. In this video, you will learn about the balance sheet classifications, long-term liabilities, and stockholders' equity. Please make sure to print the PDF handout found below this video. We will be referring to the PDF handout throughout the seminar.
Okay, long-term liabilities then are shown next. Long-term liabilities we sometimes refer to as non-current liabilities. And these would be then liabilities not due within a year. So if we have a long-term note, like our mortgage loan, right? The mortgage loan belongs down here, except for the next 12 monthly principal payments, which we stick up in the current liabilities under notes payable. And actually, we would have a separate line right under that would say something like current portion of long-term liabilities. So current portion of long-term liabilities would appear under current liabilities right after notes payable. So we'd have short-term notes payable, and then we'd have the current portion of long-term liabilities. And there we would show any principal that must be paid within the 12 months, even on that 30-year mortgage, right? So we're going to have the mortgage loan in two places then, right? The 12 principal payments due within 1 year of this balance sheet are going to be shown as current portion of long-term debt, which is going to be a current liability. And then all the rest of the principal that we still owe is going to be down in the long-term section. Okay, bonds are a form of long-term debt as well. Bonds usually pay interest every 6 months, and then the principal has to be repaid at maturity. Yes?
Why isn't interest shown in the current and long-term liability section? Because the interest could be huge.
Correct. The question is, why isn't interest reported under current or long-term liabilities? Now, I might put the interest under accrued expenses. So in my notes there I perhaps have accrued expenses. Interest, right? Owed for interest. So it is possible that interest that we owe is shown under accrued expenses. Otherwise it would show as interest payable. Now, we only show the interest that's due as of this date. In other words, sometimes we think of a mortgage loan and we say, oh, the interest on a loan is going to be gigantic. Well, we never record future interest anywhere on the balance sheet because the interest in the future isn't due on March 31st. So if I have a 30-year mortgage loan and the future interest might be $60,000 or $100,000 of future interest, I don't show that because that interest is not payable as of March 31st, 2011. I only show my obligations at this date, and we say that's the amount that's payable as of this date. So we do not show future interest.
But the long-term liabilities aren't due as of this date either.
We owe it as of this date. So the next question is, well, why do we show the note here? It's not due. It's due in 30 years. So here's the answer. This amount for the notes is payable. We do owe the full amount of the principal. They gave us the money and we owe the full principal amount. But we don't owe the future interest yet. We're going to owe the future interest as time goes on. So we're not going to show future obligations. Right? Now we could disclose that in our notes that, hey, we got a big commitment to pay interest in the future. But as of this date, we don't owe the interest. We do owe the principal. And go back to the accounting equation. If we get the $60,000 or $6 million for the bank for a mortgage loan or something, we got the cash initially, and we have a big liability, right? So we owe the bank that amount, right? And if we turn that cash into a building, we still owe that amount as of this date. All the principal has to be reported, but only the interest that has been incurred or which has occurred up to this balance sheet date that we haven't paid. Right? So if I make my mortgage payment on March 31st, I've paid the interest right through March 31st, so I'll show no interest. There'll be absolutely none. So if you don't want to go through these calculations, for example, to figure out how much interest, let's say you make your mortgage payment on the 15th. So technically you owe 15 days of interest here. If you don't want to get into all those petty adjustments, call your lender and say, take it out of my checking account on the 31st, not the 15th, so that you can have this up to date and skip all this kind of petty amounts adjusting for 15 days here and there. The total current liabilities of $133,400 then is going to be compared by many people to our total current assets. So your banker is going to look at your financials, and your banker is going to focus real quickly on what are the current assets, what are the current liabilities, almost immediately. Right? So you want to always have more current assets than current liabilities. And in a few minutes, we'll get to some of that ratio stuff that'll make it more clear. Okay, then we talked about notes payable and bonds payable being long-term liabilities. So then we see the line total liabilities. Total liabilities is the sum of the current and the long-term. So we have $173,400 of total liabilities, combining the short-term and the long-term. When you talk about financial ratios, that number, total liabilities, is used when they talk about debt. What's my debt to equity ratio? So by debt, they mean total liabilities. They don't mean what's your notes payable. They want all liabilities, and they refer to total liabilities as debt. Okay, let's move down to the stockholders' equity section. The first account under stockholders' equity is common stock, and this would be the amount the corporation received when it issued or sold new shares to investors. And so that number is usually quite small for older companies, because when they started it was 100 years ago and it didn't take much bucks to go into common stock. And then the next number, retained earnings, then is the cumulative amount that corporation has earned. So if they've been in business for 100 years, how much have they earned over the 100 years, minus how much have they given to their shareholders in the form of dividends? So this is the amount of those earnings that are being retained, not distributed to the owners. And those numbers get to be gigantic for the big established corporations. That retained earnings is just huge in relationship to the amount the stockholders initially paid. Treasury stock would be our own corporation stock that the corporation repurchased and hasn't retired it. So that's something that might happen, but we don't need to dwell on it. In any event, we put the cost there, and that reduces the amount of stockholders' equity. So let's just accept that and go to the total then for stockholders' equity, which is, in our case, $353,923. That is the difference between the amount of assets and the amount of liabilities. So let's go up here to our accounting equation. The accounting equation says assets equals liabilities plus stockholders' equity. The stockholder equity amount is total assets minus total liabilities. Right? So stockholders' equity is defined as total assets minus total liabilities equals stockholders' equity. So we just do a little algebra, and you'll see that's true. So I mention that because if the asset amounts that we show are not right, not correct, we're also going to be misstating stockholders' equity. Right? So if we show too much value for our inventory, overstate the cost and not have it accurate, or overstate our receivables or whatever, any problems like that is going to affect the amount of stockholders' equity. If we've got a building that's now worth $500,000 and we only paid $10,000 for it, this stockholders' equity is based on that $10,000, not the new number. Right? So this isn't a good indication then, it is not a good indication of market value. Stockholders' equity is the book value for the corporation in total, But book value is a whole lot different than what something is worth. So the accountants have on their books 353, 923 for stockholders' equity. The corporation might be worth $10 million for you, all we know, right? So think of my little accounting coach thing. I got maybe assets of $500. That's all I have. So do you think I'd sell accountingcoach.com for $500? No way, right? No way can you correlate book value with fair market value.